Hi everyone and welcome to Macro and Global Liquidity Analysis Gold, Silver and Bitcoin monthly update for March 2025. We're putting this presentation together for our value clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto and the Gold and Silver Standard. As per usual, I would like to start by welcoming our panel. Today we have Joe, our Research Analysis Manager, and Paul, our Director and Chief Investment Officer for the Ainslie Group. How are you going today, gentlemen?
Very good, Chris.
Excellent, Chris. Thanks for having us again.
Well, thank you for coming on. Now, this is going to be an interesting discussion, I think, because we were discussing this earlier ourselves, talking about how uncertain things are at the moment. So there's lots to analyse here to figure out where we think everything is going and where we think everything is right now. So I think this is going to be an interesting one as far as analysis goes, looking at where we are today and into the future. But just before we begin, this disclaimer we always put up, just reminding everyone that if you are making decisions, you need to seek that independent advice. This is for general informational purposes only, so we're not taking into account your particular circumstances, objectives or situations. And it says at the bottom there, we may also take positions in the markets counter to the general buy or sell recommendations provided, which may not be market neutral. All right, so we have a bit of a format that we've been consistently using on this panel on this program to go through and look at the markets. We've looked at the big picture where we are, deep dive into the macro through the liquidity cycle, Bitcoin cycle, gold, silver. We'll follow that format because that's been working quite well. But I think the point of confusion and where we want to start off today is where we currently are in these cycles, because this is the bit that's been causing us a little bit of angst. And if you look at our framework here, we're saying generally things are going up, but there's that bear market signal for Bitcoin at the bottom. Now, last month, I think we were in a similar, it might have even been a strong bear market. It was certainly that move down. Now it's bouncing up potentially a little bit, but we're not sure if it's over yet. Before we sort of kick into the rest of it, Joe, what's your take? What's your initial take on that last point about the bear market with the Bitcoin cycle? Do you think that we, at first glance, we're just in a bounce here? Is there more to go? What's your big picture overview?
Yes, that's the obvious question, is whether we are in just a bit of a bounce and a little bit of a lull during what we usually call a bull market, or are we in something more substantial? So obviously our job week to week is to figure out whether we're still in that bull market, and if we want to start continue to allocating the risk assets on these little dips, or if we think something more, there's some more serious underlying issues in the market and the structure itself where we may want to get a little bit more defensive. So obviously that's what we're going to talk about today.
And that's it. That's the question in a nutshell. And I suppose if we want to dig into the first part of answering that, Paul, this indicator is probably our go-to. It's our main staple showing us where we think we are. And it has been giving us somewhat mixed signals for a period of time, hasn't it?
It has, and it combines, those two first parameters in that framework of liquidity. So, we're still below that dotted line, we're below the dotted line again. And then we've got where we are in that macro cycle. And, you can see that on again, off again, early cycle, mid-cycle journey we've been on. Now, it's all been generally up and to the right. So we still think we're on the right path. But it's a nice combination of the two, just to, when we are seeing those sorts of dips and we're seeing those bear market indicators in that third parameter, it's good just to step back, and it gives us that sort of 10,000 foot view.
And talking about that third parameter, this has just been updated just before we started recording, and you can see there has certainly been a dip there, a substantial dip there, but that bounce that I was talking about is underway. Joe, looking at this indicator sort of independently, if you just go back and look at the chart over the last few years, really, it wouldn't be uncommon to see a pullback of this magnitude in a bull market, would it?
No, like 30-35% pullbacks are generally quite common within a bull market, and it can happen multiple times throughout a 2 or 3 year bull market phase. So this is obviously one part of what we're looking at in terms of the structure itself and underlying macro conditions. We are a little bit more concerned that there may be another leg down here. The recent bounce that we've experienced today and over the last few days is what we think is not unusual at all. Like when you get sentiment so low and those oversold conditions like they were, you wouldn't say that this bounce is meaning that we're off to the races with a V-shaped recovery.
It probably speaks to just the uncertainty piece, because most of that was last night, to be frank, and most of that narrative seemed to be that maybe there's going to be a different tariff announcement on the 2nd of April. So the market's moving with, NASDAQ was up 2%, crypto was up, 4 or 5%, all on maybes. And so it speaks again just to the fixation on what Trump's going to do next. So it's hardly a sticky thing when we don't even know the meat behind it.
And that's such a good point to highlight in terms of why we are so uncertain at this particular juncture. It really does come down to a lot of different competing narratives out there. So if we let's look at the charts and look at the data, which is what we attempt to do, we're trying to look through those narratives to see an underlying trend and what we can expect to happen. But it can be really challenging in moments like this where we're sort of in the middle, in no man's land to some degree, because we're not right at the bottom, we're not at the top, to decide what's going to happen next. And it's hard to avoid the narratives, isn't it?
Yeah, absolutely it is.
But
we have to just keep coming back to look, and we've got to have narratives. It's kind of like the AI debate, right? The data can tell you one thing, but you need a human's gut feel to some extent, or experience, just to put the context. So the narrative's important, but at the moment we've got data supporting, certainly those first two parameters in the green.
And it highlights why it's so important to have a framework, because that helps you in moments exactly like this where it becomes really challenging. So digging further into that framework, we like to look at the global liquidity cycle. And the reason we do that, as we highlight over these next few charts, is that you get a very consistent pattern in the global liquidity cycle over the very long term. This chart going back since 1970, showing that there are periods where global liquidity is falling that lead to financial crisis, and there are periods where global liquidity is rising, leading to asset booms. We have been in the rising, and you can read all about this. You can look at this closer, particularly if you're following on X, or pause there and have a look on YouTube. But we dig into each of those over time, but you can see that pattern emerging. And at the moment, this chart, Joe, I'll ask you about in one moment to highlight. We've had the upward momentum there, but then it sort of stalled a little bit recently. We seem to be getting a tick up again, but it's that stall that has been causing this confusion, because it just hasn't continued on its regular path up and to the right.
Yeah, absolutely. And I think, as we've discussed previously, it has a lot to do with just coming out of a large inflation cycle and central banks not willing to add liquidity into the markets to support the economy and the markets themselves as well. So we're starting to lean towards, it's not going to be a smooth cycle. We might end up with something like at the start of that, over to the left of that chart, where 2016, 2017, we had a choppy cycle, which, like you pointed out, is very stop-starty. It doesn't necessarily mean we're at the end of the cycle, but it just means that there's going to be points in the cycle where there's going to be opportunities to buy the dip, and there's going to be opportunities to potentially sell the rip.
And it would be very unusual. In fact, we would be very unlikely to say that the cycle has ended down here. We're too close to the bottom, right? Like, we know that more liquidity has to come into the system. It's practically just the maths, as Paul always says around this. It has to happen, but the timing of that can be stretched, and you rightly point out on that earlier cycle that's highlighted there, it can take a while.
And just to expand on what Joey said, because I think it's the crux of it, is the magnitude of that inflationary event we hadn't seen since the 70s, right? Has got central banks clearly nervous. It also, the response that actually fed that from COVID was that incredible money printing exercise that had their balance sheets expanding to a very large extent. They all prudently don't want to start that again with interest rates up where they are. So I think they're going to hold as strong. So they're doing QT, so they're trying to get rid of all of that accumulated debt off their balance sheets, so that when inevitably, because there's $9 trillion of debt that has to be repaid this year, refinanced this year, that they'll have the capacity, I think, to then open the printer gates again and start with the money, but they've got to try and get it down. They've got to buy their time, and I think that's why they're holding strong.
And that makes a lot of sense to me. If we dig into some of that graphically, the holding strong aspect of this, if we look at, first of all, the sources of global liquidity, we've talked about this a number of times in the past, I won't dwell on it today, but it's really just highlighting here that there are multiple factors that make up global liquidity. A big component of that is the collateral pool, which you can think of as the borrowing capacity or the capacity of central banks to and economies to operate. If we look at specifically the central banks, they have been the point of contention here because we've been saying for a while now that it's really, yes, we're seeing a lot of green on that chart, but it's really the central banks that haven't come to the party yet, the major central banks at least, that have been holding all of this up. And looking at that just objectively, if you were to look at that chart, you go, well, things should be pretty good right now. But when you zoom in and actually look at the majors, that's when we start to identify some issues there. Paul, we've talked about this quite a bit. The Federal Reserve there that is really holding everything up right now, but that's not on the back of them really doing a whole lot. That's more technical, isn't it?
Yeah, that's it puts the others into context, to be honest, for that to be green compared to the others, because it was still very little in comparison. So really it was them draining the Treasury General Account, so the TGA, and offset somewhat by the reverse repo going up, but and they've brought back their QT back to 5 for bonds, but they're still fully engaged with the MBS. So it's not a lot. It's just more than the others at the moment.
And it's certainly not enough to hold up the entire global economy, which we'll talk about in a minute. But that needs to be substantially more across the board. Would be the argument there. Joe, I want to ask you specifically about the weekly data here. If you zoom in, or probably not zoom in, but look at this from a different angle, you can see that we're certainly pointing up at the moment, but that's really quite stagnant if you were to go back and look at that over the last 12 months.
Yeah, so we actually failed to break a new high there. At this point, we haven't broken through all-time highs. And, if you're expecting risk assets and like Bitcoin and NASDAQ and stocks, for example, to continue ripping higher when you can't get the support from liquidity, then I think you're probably a little bit naive. In terms of what's actually driven that bump in global liquidity recently, as to what Paul was saying, we've had a sharp drop off in the TGA, so positive liquidity of $300 to $400 billion coming out of the TGA straight into the US economy, and coincidentally, we've also had a falling dollar. So the dollar's been falling in, which denominated in other currencies obviously adds to global liquidity as the US dollar weakens. So in terms of those two things, whilst there's still some money in the TGA there to be spent down, we're also approaching tax season in the next 2 to 3 weeks when money's going to be drawn out of bank reserves and bank accounts back into the TGA, so that's liquidity negative. And we also don't expect the US dollar to continue falling at the same rate that it's been falling. It had one of its worst. It had one of its worst weeks in not last week, the week before in a number of years. So you just can't expect that to continue on its downward trajectory.
And we'll dig into that now, actually, some of those components that make up what's going on in the economy that are reflected in that liquidity backdrop that we can see there, or that are reflecting is probably more accurate, reflecting that liquidity backdrop. But the macro cycle is really important to understand, because that's the other half of this equation. We can go, yes, liquidity is driving it, but ultimately the business cycle matters. And Joe was joking just before we recorded this, he hates this chart because it never does anything. This month, it looks like it's finally doing something, so I'm going to take the excitement away from him and go over to you, Paul. When you look at this chart, there's a little bit of concern there. If you were not looking at our leading indicator, you would actually probably think things are pretty fine, but that's not the case.
No, and this is ISM's PMI. So last night we got S&P's PMIs come out, and they had manufacturing dip below the 50, so only just 49.8, and services was actually up to 54.3. So it's a mixed bag at the moment. There's arguably, particularly on the manufacturing side of things, a bit of a front running of the tariffs that might have brought that forward a bit. But so that's 50's basically stagnant. So it's certainly nothing to get excited about. But very vaguely you can draw a line up and to the right. But to Joey's point, it's a pretty flat line. So we're not seeing strong growth indicators yet, and certainly that leading indicator would suggest it's going down. So it's not a strong environment.
And that's exactly what the US Treasury is trying to do, right? Like they're trying to slow the economy, they're trying to get yields down, and in their minds, this is probably exactly what they want to happen, and to transfer money out of the stock market into bonds, to bid bonds up and yields down. So, they've said repeatedly they're not necessarily worried about the stock market at the moment, and they're basically telling that to our faces. So when they're telling that to your faces, you sort of need to stop and pay attention.
Yeah, and that orange arrow is on 50, right? So they want the Goldilocks. Bessent's outright said he doesn't want a recession, right? So their aim isn't to put America into recession. The aim is just to get it tighter so that, as you say, they can lower yields, but certainly not anything to celebrate.
I think my concern there, when we look at that leading indicator, and I know, so for people who don't understand where that leading indicator is coming from, it's a combination of inventories building up, which is obviously problematic for new orders that come through and new orders that are looking forward. So my issue a little bit with that is that as these things slow down, it can be by design, as we were discussing, that might be ultimately what you've got the administration wanting, but it's very tricky to fire these things back up again, particularly when you look at it at a global scale. And this chart that we brought along this month is probably the most concerning data point for me, because it seems to highlight that it has been quite effective, this policy, particularly since, because if you think about this, some of it was probably already in place before Trump had come into office, but when you really look at where this is pulled back, it is under the new administration. This isn't just looking at the US though, there's flow-on consequences that appear to be happening here around the world, and we're not that far above zero when you look at growth through this lens. Joe, do you want to tackle that maybe a little bit about, is this potentially the bottom here? Because if it all picks up, we're all good, but if it continues down, we don't want to say that R word, recession, but it's something that will start to come on more lips if we see this falling further.
Well, I don't think it's about to take off. I think that we can start by saying that. There'd have to be a severe policy change from the US for that. And I know that I'm talking about the US specifically, and this is a world GDP chart, but when you think about the US being the first or second biggest consumer for every other nation in terms of every other nation's exports, if the US consumer is slowing down, then you can bet your bottom dollar that every other country that exports to the US are also going to start slowly, their growth is going to slow as well, if they're not able to export as much. So, you can see towards the end of last year how we was remaining quite elevated, and that was a lot to do with the policies implemented by the Biden administration with Yellen, and issuing short-term debt and keeping the economy juiced into the election, which ended up didn't helping them in the end. And now we're starting to see the tightening of policy, or particularly from the Trump policy, the Trump administration, where they want to bring those 10-year yields down, which lines up with exactly what we're seeing here in terms of growth.
And look, it's not all straightforward either, because again, that S&P print last night had growth at 1.9% or 1.5% for the quarter. That's in stark contrast to the Atlanta Fed's quite dire estimate. But and then the other thing too is, so if that's the rest of the world being sick, then as we've just seen with Germany approving $1.1 trillion in defence spending, that will come through in growth figures. So there is some stimulus coming in via that sort of instrument that might help support this a bit. So the isolationism might force others to pick up the GDP baton and run, but and certainly the latest S&P print is stronger than that. So it's a bit hard to tell.
And to be sorry, I was just going to say my concern on that is, or my hope on that, actually not my concern, my hope on that is that then creates this bottom that we can see in this chart, because the rest of the world does step up to the plate. Because as Joe, some of the points that you were highlighting there, it's not looking great from the US perspective.
Yeah, and I do agree with Paul in terms of that defence package being effective, like quite a lot of stimulus into the German and European economy. I suppose if we're looking a little bit past that, they're going to issue $1.1 trillion worth of debt at, and Europe, the bonds haven't exactly, German bonds haven't exactly been, yields haven't exactly been falling. So at what point do the ECB have to step in and start up QE again, because they're a lot closer to zero than what the Fed are. So it's just another step in the direction of QE and money printing needing to be implemented, because at some point your bond market's going to blow up if you keep issuing large amounts of debt like that, particularly for defence spending.
And that could be a real positive too, because markets tend to front run this. So the market may be able to see through the issues in the US and start looking to the rest of the world. It's just we've been so reliant on the US for so long as the main driver of this economic activity that will be an adjustment for everyone. I think. I don't think it'll be a quick process. The other side of this is inflation, and we've highlighted for several months now that really inflation isn't an issue. Paul, people still think or seem to be going on about it and think that there's going to be a real issue from tariffs. I tend to fall a little bit in that camp, because most of the people who are telling me that inflation is not an issue are talking about what Joe was referring to, and you were as well, the front running, that there's a lot of people that were buying goods ahead of the tariffs coming in so that they already had supplies. But when we're a few months in and those inventories run down, the tariffs surely are going to have some level of inflationary impact. How do you view this chart?
Well, for a start, we've got the latest CPI print, which was 2.8, so that purple line is heading down, which the orange line is saying it should. Most people seem to think tariffs are going to be inflationary. I've heard some very clever people articulate very clearly why they're not, and so I think frankly the jury's probably out a little bit. I totally agree with you. This whole front-running thing, if ever there was transitory, it's that, right? Because there'll be a hole on the other side of that. I think on balance, I'm more inclined to think it's going to stay low. I think they'll manage it to the point where because they have to get rates down, okay? So they'll be very mindful of inflation if they want to try and soften the economy to help on the employment side of things, then the other Fed mandate is inflation, and they'll be very, very careful not to inflame that, because they need the rates to come down. So I'm probably on the camp of lower, not higher.
And on that point of rates, if we go, this has been a really important chart that we've looked at for a while now. We've had government debt and yields, really those Fed funds rates coming down, but nowhere near down enough, if we zoom in on that, nowhere near down enough to where they need to be to refinance that debt at reasonable levels. Looking at those bond yields, Joe, I've been a little bit confused about this for a while now, that during this sell-off that we've had over the past month, where really it has been a significant, not necessarily a full-on crash, but a significant sell-off in risk assets, the bond yields have not really been responding the way I would have expected. I would have thought that there would have been a rush to safety. We haven't really seen that. If you looked at this chart in isolation, you would go, well, nothing's really happening. It's just sort of plodding along sideways. How do you interpret that?
Well, it's interesting. Back to what I was saying about Besant wanting to move people into the bond market and out of the stock market. He doesn't really mind too much about what happens to the stock market at the moment. We're basically seeing yields drop in line with the Nasdaq and other stocks, like basically moving in lockstep there for a while. So we've had a little bit of a bounce in stocks. So, like what that's telling me is that I think the market thinks that Besant is not going to act until he gets that large sell-off in stocks, right? And it really starts to impact. You get that where you get that wealth effect from high asset prices. So I think if you start seeing the stock market fall again, then bonds are going to move. Bond yields are going to drop in lockstep with the stock market. So we did an episode. Was it last week? It might have been the week before, where the top 10% of consumers in the US are something like 40% of the spending into the economy, and the top 10% also own 80% of the stock. So if you've got the biggest consumer in the US getting that negative wealth effect, then and they're not going to spend, and that's going to slow the economy. So I think once Besant and Trump see large falls in the stock market, they know they're going to get that negative wealth effect, and I think that's where they sort of start to step in, or possibly even the Fed start to step in with inflation somewhat subdued and employment ticking up.
Paul,
Chris, I don't think we can discount either that part of this is the ramifications of Trump's actions is that you've had more sovereigns not buying bonds. Right, so if foreign sovereigns were and have always been some of the bigger buyers of US Treasuries, if they're pivoting to gold as the stats tell us they're doing, then you may see that flight to safety now being a flight to gold as opposed to a flight to US Treasuries. So that could well be part of this, but in lockstep with what Joey's saying, I totally agree with as well.
and I'm going to ask you a little bit more about that because it's a fascinating idea, and we've got a gold chart a little bit later that I want to tie that to, because gold really has been relentless in its move upwards, and that is also something that's been confusing me alongside this. So that's a really good point, and we will definitely come back to that. The dollar is obviously a very important part. I say obviously, but it might not be obvious to everyone. But really, when it comes to global liquidity, the dollar means a lot, because if you've got a fall in the dollar, that's effectively increasing everyone else's in the world's liquidity. So it's a very helpful mechanism that can result in more liquidity. Paul, we've got here a cycle that's in place that, these things aren't exact. It's not exact science, but it looks already like we might be ticking up a little bit. If that were to be the next move heading upwards, is that going to potentially have some headwinds here for those risk assets? Because we've certainly had a little bit of tailwind being provided by the fall in the dollar. Well, we were until we had that significant pullback. How do you view the dollar here?
Yeah, I mean, it's hard to ignore that chart. So it would seem like it's probably going to have a bit of a rally from here, and you're absolutely right. That'll be headwind to the liquidity index. What we have to, I keep going. The four most expensive words in investment. It's different this time. You could argue that Trump's actions will keep weighing on the dollar, but again, you'll get very smart people to say how it'll be constructive for the dollar. But it may break the rhyme this time just because of the extended nature of what's going on.
If we do get another fall in the dollar from here, which would, I would be surprised if we do, then that's sending a clear signal that there's something broken in terms of the DXY. Like there's deliberate devaluation of the DXY one way or the other. Because it shouldn't.
It would be very good for liquidity if that were to happen.
It'd be very good. Yeah, it'd be very good. But like technically looking at that, you shouldn't necessarily have another massive leg down. And if it does, then it's telling you something.
And part of it could be just the sheer amount of foreign sellers of US shares of late. It could be weighing on it as well. So that only has to reverse or stabilise, and you've got one big trigger gone just in that.
So one to watch, but not necessarily the easiest one to read right now, with a number of factors playing on it. If we move our focus a little bit to the Bitcoin cycle, because we trade that for some reasons that will hopefully become obvious over the next few slides. Firstly, we know that global liquidity leads world wealth. It's been consistently doing that for a very long time. It makes a lot of sense logically that how much money is floating around the system is going to dictate the prices or the dollar value of assets. We've talked in the past about monetary inflation hedges like gold and Bitcoin and the role that they serve versus when you're looking at generally inflation being that dotted line down the bottom that doesn't really, your wages, if they follow inflation, don't really keep up with the broader asset price inflation. You could also think of that as a wealth gap or the rich getting richer as that line moves up and to the right. So that's one reason why we look at it. But this chart is one that we've brought up the last couple of times we've looked at this to really drive the point home that Bitcoin, out of the options available to us on this list, is the one that is the most sensitive to global liquidity here. Joe, do you want to talk about this briefly just to catch people up if they haven't been paying attention to what we've been looking at on this chart?
Yeah, so when looking at assets that are going to benefit most from liquidity rising, you want to be in the asset that's going to be the most sensitive to liquidity, right? So it's most positive correlated with the largest multiplier. So historically, it's obviously slowed down over the last 18 months in terms of because the Bitcoin market cap has risen. So historically, you get a 10 times multiplier for every 10% rise in liquidity, right? So that's obviously a very large move. Over the last 18 months, we've only had 5 times multiplier on every 10% move, which is obviously still a very large move comparatively to every other asset that you can own. You've also got gold in there, which is not even arguably, it's definitely a more stable asset, but also has that positive trend towards liquidity. So, sometimes when we believe Bitcoin's overvalued, we'll move into something like gold, generally speaking, so we to protect gains and sort of protect us from market volatility.
And silver makes a little appearance there too, which is actually shows quite clearly why we like silver, because you do get that little bit of extra juice out of silver at the right time if you're invested at the right time.
And interestingly, gold's actually picked up its sensitivity to liquidity over the last 18 months as well. So, there's probably a lot of different things like what Paul's talking about in terms of geopolitical risks that are probably helping that. But it's been an absolute tear. And
getting our focus back on Bitcoin specifically relative to that global liquidity cycle, we've seen this chart. We were joking last time, a little tiny uptick that we had the slightest hint that we were starting to move in the right direction. Paul, we're not exactly seeing robust rate of change here. We're only just above zero, but it's still heading in the right direction. And when you zoom out and look at this Bitcoin price on the logarithmic chart, it really looks quite promising if you were to look at it through this lens.
Yeah, absolutely. Because they're miles apart there, but the directionality is pretty consistent. So as we're starting to get this tick up over the last couple of days, and that might be this starting to come through, but it's certainly encouraging that it's consistent with what we think is coming.
And Joe, if we also look at that through a different sort of perspective, a much closer view, we've seen this chart. I mean, if you look at it today, that blue line will be pushing upwards a little bit. These are updated at the end of each week to get the average price for the week. But the liquidity certainly looks fine here when we look at that weekly level pointing upwards, that it should be supportive for Bitcoin in the next little while. We're not entirely sure, but at the same time, if you think in terms of averages, it's pointing in the right direction.
Yeah, absolutely. Like I spoke about on the global weekly liquidity chart that we brought up earlier in the chat, our only real concern at this point is over the next 4 to 6 weeks, you may end up getting that air pocket which realigns those lines somewhere towards, with the orange line pointing more down towards Bitcoin. So it's potential that Bitcoin's already sniffing that out. It doesn't necessarily mean that it's absolutely going to collapse, but I think potentially over the next 4 to 6 weeks, the best case scenario is we just chop sideways in liquidity while we go through that seasonally rough patch.
And the 4 to 6 weeks angle, I think, is something that will be interesting to see play out here. When we try to look at this through a bit of a cycle lens, this will undoubtedly be a messy cycle because we've already established that it's been choppy. Identifying the start of that 60-day cycle on the back of this Bob Lucas work has been tricky. You've got a 60 point that doesn't really look like it's at the bottom. You've got it's a mess, right? Like it's a choppy sideways cycle. We were somewhat expecting that, I suppose, but it will be interesting to see just how high it can get. And this was a point you were making probably at the start, Joe, about we knew there would be a bounce here. How high it goes and what happens next is probably really quite important in determining what happens over that next 4 to 6 weeks you were talking about.
Yeah, absolutely. And that's where this is, part of our TA analysis, but we're also looking at that macro analysis in terms of, potential liquidity conditions going forward and policy coming out of the US in regards to trade and wanting to reduce the deficit and potential austerity. So we're really just, we're obviously looking at this, but we're also trying to pinpoint that pivot in terms of policy from the US as well, to help us sort of pinpoint to get in.
It's probably worth expanding a bit you mentioned that April air pocket for newer viewers, because we sat here a year ago, and so just so everyone knows, in the middle of April, all the taxes due, so all that money comes out of people's bank accounts into the TGA, which is effectively taking liquidity out of the system. And we saw quite a pronounced air pocket last year. That's in the coming period of that chart, and that 4 to 6 weeks that Joe's talking about. So TGA, as we've just seen with the Fed in the last month, can be emptied. So they've taken a few $100 billion out. So that they didn't last time. That may well have been, in the lead up to an election and not wanting to inflame inflation and that sort of thing. They may not be so minded this time. So we don't know if that air pocket will be as pronounced as last time, but it's certainly seasonally fairly predictable. And then we've got the other side of that front running of the tariffs and whatever comes out on the 2nd of April that everyone's speculating, that could see a bit of a pocket as well. So this could absolutely be a very choppy sideways cycle, in my view. There's a lot going on.
Yeah, I think you've got to add also, if people are pulling money out of the markets to pay their tax bill, that's obviously going to have an impact on the markets themselves. So it's hard to say, but I think potentially a lot of that's already happened. As soon as there's a little bit of uncertainty in the markets, well, what's the first thing you do? You take your money out of the assets generally that have probably performed the best. And that's stuff like the NASDAQ, the Mag 7, they've all just been absolutely hammered, stuff as well as Bitcoin. So, like I said, some of that's probably already happened, but you've also got the ongoing effect of liquidity potentially drying up in the banking sector, like you pointed out, Paul.
I think the other side of that, though, is this chart. There is certainly, we refer to it, tongue-in-cheek, as a fish finder view, because you can see a little fish below all the little liquidity points that the market tends to want to target. There is still a lot of speculation. If you were to view this chart as a speculation chart, you can see a lot of points that the market didn't take out to the downside that are still at play. Joe, you look at this fairly closely. Do you think there is still risk just from that angle that all the speculation has not been wiped out yet?
Well, that's exactly what this chart is telling us. So what it's telling us is that if the price were to get down, let's look at that range between 83 and 85,000. If the price was to get down to those levels, then there's a lot of longs that would be liquidated, right? And as we've said before, the market likes to inflict the most amount of pain on the most amount of people. There's nothing really above there, which indicates to me is not necessarily a lot of people are shorting at the moment. There's obviously people shorting, but there's no one who's shorting that's about to get liquidated. So if I was to make a call in the short term, it wouldn't surprise me to see price move to that $83,000 to $85,000 range. And obviously we've got those liquidation points down at 70, a little bit at 70, a little bit at 75. That's obviously quite a drop. Something significant would have to happen in the traditional markets for that to occur. But I think anything around the 83 to 85,000 is probably a decent buy, and anything under that, the 70 is an absolute excellent buy.
And we're not out from that point of view, we're not out of the woods necessarily yet. We'd have to see really quite significantly higher prices to discount all of this yet.
Yeah, that's correct. So the more it moves away, the less likely it is to hit those areas, because obviously it's going to take a larger move to hit those liquidity pockets. That doesn't necessarily mean that those pockets have to be hit. There's just a more of a likelihood that they would be hit, particularly if they're close by. That
makes a lot of sense. Paul, gold and silver have been absolutely on the tear. We've talked about this quite a bit. I'd love to dig into this month a little bit more of what you were talking about before, this idea that potentially some of why we've seen gold so strong is on the back of central bank buying, or really not just because they're buying because they want more gold, but buying because they're looking for an alternative to buying treasuries as a concept. I think that's really interesting. I was expecting the market to sort of turn over a little bit when we started to see those sell-offs in the other traditional risk assets, because often people liquidate gold positions at least early in that process to get some much needed liquidity, personal liquidity, to be able to bail themselves out of their situation that they're in with the rest of their portfolio before coming back later. I'd just love for you to explore that a little bit more, this idea of what is going on here, because it really has been very, very strong in the face of what would normally be challenges.
Yeah, you're right. So to be clear, we often talk about gold being uncorrelated, right? So as shares tank, gold often goes up, but that's not usually straight away. So as you said, there's people have this immediate pain of margin calls or whatever it might be, and they sell, as to Joey's point, for tax. You sell, your most liquid, successful asset, and that's gold for a lot of people because it's just been on a tear this year. So, but we didn't see that. We've just seen gold just keep going up, and I think it's probably no coincidence that the reason for share markets tanking is also, hand in hand with a whole lot of geopolitical turmoil. So we're definitely seeing central banks buying up gold. We're definitely seeing major players that would ordinarily trade in paper derivatives, be that futures or ETFs, taking physical delivery, which is just adding real demand as opposed to made-up paper demand. So we've got that dynamic as well. ETF inflows have been huge, in maybe not in the last week or so, but certainly over the last few. So the demand for gold is not letting up, and that's being reflected in the price because it's that chart's not up to date. It's whatever it is today, 3,030. It's I think it's wearing both hats at the moment. It's that safe haven, and then it's also got its geopolitical bent as well.
Absolutely. And that chart, and the silver one that I'll bring up now as well, they're just reflecting those average prices for the month, as you point out, that they've been even stronger than what it visually looks like there, which is just fantastic for those investors who've been waiting a long time, particularly in silver. Silver's an interesting one, though, and I'd like you to sort of explore this a bit. And Joe, I might get you in on this as well to just discuss what's going on there, because if you think about silver as an industrial metal, then we probably would have expected to see a little bit of a sell-off with those other risk assets when that was happening, but it held up quite strongly as well, which really, to me, was indicating that maybe people are looking beyond the industrial aspect here and looking at it more as a monetary metal. Is that how you interpret what's been going on recently, Paul?
Yeah, and we've got to go back to that chart that Joey pointed it out. Silver has a higher return on liquidity than gold. You'll note on this chart and the previous, the directionality is beautiful. Like in terms of when liquidity goes up, so goes the metal. And Bitcoin just had that bigger bar in that comparison because the multiples are bigger. But so silver has, so for all that talk before about golds, the deliveries of physical silver have been phenomenal. The amount of physical going into SLV and these silver ETFs has been phenomenal. And this is in an environment of where we're already in our fifth year of deficits and a few more forecast. So yes, you would think when you consider solar panels, electronics, and medical and those sorts of things, with China being lackluster, you'd expect those to have come off. But and that's the other thing at play. This isn't even fully reflective of what's happening in the general market because China are devouring, not final form silver that doesn't show up in these charts. So they're very cleverly accumulating silver without even pushing up the price. So, and to our earlier point, we probably are getting towards that late cycle period, and that's where silver really takes off traditionally, is in a late cycle. So we're at 90 odd to 1 gold silver ratio. It's hard to imagine that's staying that high for long.
And Joe, I want to bring you in on that, on this discussion on silver in particular, looking at this gold silver ratio chart, because it's been a long time coming. This is a very long chart. This is going over 100 years that you're seeing us back up at those levels where the GSR is really high, when you're sitting in that sort of 90 plus region. It seems we've talked about it quite a bit, saying that later in the cycle, silver can really have that kick further forward. How do you view the potential of silver here from that perspective, from the perspective of it being an investment in and of itself, I suppose, where we tend to use gold more as the offsetting hedge against our Bitcoin position? How do you think about silver for people who are maybe wanting a I don't know, they're maybe not as interested in the Bitcoin angle or not quite as confident with crypto. What's your general take with it at these levels?
Yeah, so if you're specifically just looking at precious metals and you're looking to obviously juice a little bit more gain during the cycle, then silver's obviously, around the middle to end of the cycle, potentially what we're coming into is a good time to get in it. The only caveat I'll throw in there is if we do get somewhat of a growth scare, we'll probably see that GSR rise a little bit more. But I would be looking at as a very favourable trade opportunity, because if we do go into that growth scare and silver sells off, you can bet your bottom dollar that once the taps get turned on and the global economy starts to pick up again, silver's going to be well bid, and it's going to be a fantastic opportunity. So it might be something where you buy a bit now, and if you get lucky and there's no growth scare, you do quite well comparatively to gold, or you might hold a little bit back. And if we do get a seller from a growth scare, you just dive in.
Yeah, that makes a lot of sense, and I think it's really interesting too that you can look at this. You don't have to necessarily be thinking about it in dollars when you look at this chart. You can be thinking about it in terms of how much gold you ultimately end up with. So it can be quite a good longer term trade setup situation for people who aren't traders in the in quotes the traditional sense, but like to just maybe switch that back and forth when it really makes sense. And now would be a time that makes sense for the silver aspect at least.
Yeah, relative to gold, it's clearly undervalued. So if you're happy to wear a little bit of the GSR going up, if it were to get a little bit of a sell-off, then you just wear it, and with the knowledge that at some point it's going to revert back to the mean, and you're going to make more gold.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenised gold or silver anywhere in the world, check out the Gold and Silver Standard for security of real-world precious metals combined with the flexibility of blockchain. Now, we always like to add a little bit of value at this point, looking at a trading plan that we've been following along really since the beginning. It's quite straightforward. The idea is that we look at where we are in those cycles, really what we showed from the very start, where we are in the liquidity cycle, where we are in the macro cycle, to determine if we're at the start or end of that cycle. We identified that quite clearly on the chart back in the 10th of January 2023. That was our buy signal, where we went, okay, it's all lined up, we're going to buy here, and we've been holding that ever since, which has done exceptionally well. So even with that pullback recently, we're still sitting at nearly 410% over the last 814 days. So if annualized, you're looking at that, a little bit under 200%, but still spectacular returns for really what was a very simple trade. When we say simple trading plan, couldn't get much more simple than just buying some Bitcoin and holding it through that cycle. So we'll keep you updated with that, but that's our general approach that we would suggest or offer here for people who maybe don't know the ins and outs of or want to be in and out of a position, but just want to buy something and hold it through the cycle. That's how we would approach it, and so far we've been proven to be very correct on that approach. Okay, well, that brings us to the end of our chart pack and the things that we would like to go through methodically every month. I think if we'll go around, we'll do the round of the grounds and just sort of wrap up on what people are thinking for the month ahead. I might start with you on that one today, Paul, and just get your perspective on what you're thinking.
I think the month ahead with April could prove challenging, and what I think everyone needs to remember is that when we're at these points, there always seems to be a new narrative for why it's different this time. It certainly feels extreme with what our daily newsfeed is intriguing, if nothing else, and that's having a huge impact on markets, and it feels unprecedented, and it feels like it's different this time. But we come back to that framework and we look at the data, and the data is saying hold strong. And I think that's something just to be I think Michael Howe, we say again, he's saying keep dancing, but just dance close to the door. We just need to be ready to act if that turns. But at the moment, the data is supportive of our thesis that we are still nowhere near the end of this cycle.
Joe, what's your What's your general take?
Yeah, I don't really have much more to add to that. If we do get another leg down in risk assets, I'd definitely see that as a buying opportunity, and we're keeping an eye out for what would be a change in policy from either the Fed or the Treasury. Reinforcing we don't believe we're at the end of the cycle. We're just potentially going through a bit of a rocky period here until liquidity gets resolved one by the other. Either it comes on by itself, or the Fed or central banks are forced to act. So that should be a pretty clear signal when it occurs.
For me, I think I'm quite concerned in the very short term, or maybe short to medium term even, that we haven't seen the bottom yet in those risk asset markets. And it echoes what both you and Paul have said there, Joe, like this idea that really we could see one leg or one significant leg lower if that growth chart, it really is the one that's sticking in my mind at the moment. That global GDP chart continues heading down. So I am a little bit worried about that. But I keep having to pull myself back and remind myself that regardless of what happens here, we still expect much higher prices out of that, because we know what the outcome of that is. The bigger the crash, the more bullish we can get, really, in terms of where we end up after it. So I probably need to not be too concerned, but I probably need to be looking further out. So time frame matters, I suppose, is how I would wrap that up. But in the short term, I'm probably a little more scared than the other two here in terms of what I'm worried about. But hopefully that will all be done and dusted by the time we join again next month to see. Particularly, we should be well into that April air pocket that we've talked about by the time we're back. So let's see how that unfolds. Well, that's us for today. So thank you, as always, to Joe and Paul for your contributions and analysis today. Really value that. I think the audience does as well. So thank you very much.
Thanks, Chris.
Thanks, Chris. Thanks for having us.
Always value your feedback and discussion. So you can follow me on X at Tipper Analytics. Reach out on the Ainslie channels with any comments, feedback, anything you want to say at all, and we'll continue to refine this process that we have each month. So far, we've got lots of positive feedback, so we'll continue doing what we're doing until you tell us otherwise. But we'll be back in April, as I said, to discuss where we are at that point with the next monthly update. We'll see what's changed. Hopefully, we're looking big smiles on our faces, everything's recovered. If not, who knows? We'll assess it at the time. But until we chat again, thanks everyone for watching, and good luck in the markets.